to another weekly episode. Do keep your notifications on if you want to know whenever video is released on this channel. So today's episode is about understanding what is happening in the market given the Middle East escalation. If you also look at a lot of global market charts, a lot of charts are in a pause mode. They are not heading down, they are not heading up. So I'll just explain what is currently happening. So what is happening is that market is actually forming a holding pattern, which is nothing but a form of time correction. And this holding pattern concept is something that we understand from the aviation sector. When a flight goes from path A to path B, that is its destination, many instances the air traffic controller instructs the flight to go in a pattern and then follow to the destination route. This is very common. And this is currently what is happening in the market. Plenty of times flight go through a holding pattern because of the ongoing traffic, because of weather conditions, or it can be any number of reasons. Basically, it is clarity of the ongoing traffic and ensuring that there is safe travel in between. And that is what currently is happening in the market. So there are three phases of holding pattern that the market typically undergoes. The first is time correction. So currently we are undergoing some form of time correction because we have had a sharp rally that began in March 2025. And it is a phase of sideways consolidation that is going on over the last 40 odd days. This is not unusual. Periodically, every time that we have a leg up in the market goes through 3-4 months of time consolidation. The second important thing about holding pattern is pause in directional momentum. Now you have to understand that in current context, most of the indices in leading sector stocks, which I'll come to towards the later part of the video, are having a pause in directional momentum rather than a breakdown. There are very few breakdowns that are happening in the market. The third is waiting for clarity. Again, in today's context, that clarity is about significant geopolitical hang that exists on the market. Whatever is happening in the Middle East is concerning because now things seem to be escalating. My personal belief is that this market is heading higher. 3, 4, 5% volatility can happen. That is normal in stock market, but over time, this market is heading higher. Again, that is my opinion and I can be wrong. But these are broadly the three phases that the market is currently going through, which forms the holding pattern of the market. Now go through the stronger groups and the weaker groups to understand what is happening underneath. I'll be reading a couple of things because the notes I've made is about the stronger pockets and the weaker pockets. So first is the strong pockets of the market. Strong pockets have taken a breather. However, their retracement has not been sharp. If you open up the indices of capital market, defense, Nifty Bank, Nifty Finance, private banks, the retracement is not sharp at all. Instead, we are seeing constructive pullbacks marked by tight price action and lower volumes, a classic hallmark of healthy consolidation. A chart of this I had posted on my X profile. Go back and check what exactly tight price action means. I'd shared the chart of weekly time frame for private sector banks. Now, leading stocks in strong pockets. What are these stocks doing? Leading stocks within these sectors are starting to re-emerge. Many are forming tight ranges, flags, or shallow bases. That is a shallow pullback on the chart. I'll show you some examples later. All while showing rising relative strength. That is against Nifty 50 or Nifty 500, the RS line is still heading higher. This is a positive development as often it signals institutional accumulation during a phase of overall market indecision. See, plenty of times when the market is heading higher, this is not when stronger players accumulate. It is during indecision and uncertain times. That is when accumulation happens in stronger pockets of the market. Now, leadership. Where is the leadership still? The leadership is still with banks, finance, defense, travel tourism, capital market, hospitals, chemical agri, and realty. There are plenty of smaller pockets also, but because those pockets don't have indices, I haven't posted the chart here. But in general, these are the strong pockets in the market. Realty, I won't consider it as strong yet. It is trying to move up, but there are some signs within individual stocks in this pocket. That is why I've included it here. I've also included, I think, realty in the poor, that is the weaker kind of pocket in the market. I'll explain that in a bit. Now, let's come to which are the top performing sectors year to date. It remains defense, finance, private bank, bank nifty, capital market, CPSE index, infra, commodities, oil and gas. Then comes Nifty. Nifty, I think, is about 5% year to date. And what about the weaker pockets? Weaker pockets are consumer durables, IPO, IT, media, pharma, small cap 250, healthcare, FMCG, realty, small cap 50, mid small cap 400, mid cap 150, mid cap 50. This tells you that the broader market recovery is still not there in place. I was reading an article and subsequently watching a video of one of the prime news channels, and there they were highlighting that the recovery in the mid cap and small cap segment has been fantastic. That is just not true. It's just not true because limited names are being tracked when people are speaking about mid cap and small cap space. Majority of the micro cap stocks, mid cap, small cap 400 stocks are still below their 200-day moving average. If you look at the average performance of all the major sectors in the market, average is just 2.18% for the year, where defense is about 35% for the year and consumer durables, I think, is negative 14%. That is the kind of divergence that is playing out between top performing sectors and sectors that are still weak. Realty at one point was actually down more than 15-16%, and now it is down, I think, just about 2-3-4%. That is why I've included it in one of the strongest pockets that one should pay attention, because the net improvement that has happened from the lows that realty sector made is significant. So let us now cover the weaker pockets of the market. Again, I've just taken some major industries and sectors of which charts are available. First is metals. Metals was actually one of the sectors that I was tracking very closely, and I thought this sector would do really, really well. But I think this sector is still failing to go up because of what is happening between either US and China. There are a lot of things at play that above our pay grade and we cannot understand. But I still feel this sector has a lot of potential and I think it will set up. In fact, a lot of individual stocks from this sector have already started setting up. That is usually a cue of broader market sector improvement also happening. So let's see, I'll update about this. IT remains weak. It's mainly because of the US market. I also think that IT was a rank outperformer in the previous 4 years, so I don't think it is going to perform very well. It may move with the market. That is, if Nifty goes up 15% over the next 3 years, IT can also go up 15%, but it is not going to be a rank outperformer. Small caps, mid caps, FMCG, consumption. These 5-6 names and micro caps also, I haven't included it, but these 5-6 sectors or broad pockets still remain very weak in the market. But there is something I noticed. First, I'll just speak about weaker pockets in general, then I'll come to the stocks. So in weaker sectors, they failed to rise meaningfully to support the index. This lack of broad-based participation has kept the indices pinned, contributing to the perception of market fatigue. So we are listening a lot of commentary about market stalling and market not wanting to go up, but actually it is because of the weaker pockets in the market. These pockets are just not rising to support indices, and that is why we are getting a feeling that the market is at a fatigue level. Historically, sustained rallies require broad sectoral strength, or at least some rotation where lagging sectors can catch up. This is what is not happening in the market. And in my view, the two important names here are metals and IT. If metals and IT just start performing as much as something like a Nifty 500 or Nifty 50, I think much higher levels will come up sooner. Interestingly, not all is quiet on the weaker sector front. Pay attention here. Select stocks within underperforming groups are showing signs of life, not through explosive moves, but by tight consolidation and rising relative strength line, which means there is silent accumulation happening in a couple of these sectors that I was just speaking about, especially in metals. So this is something that you will only find if you go through sector charts and the stocks within those charts on a regular basis. This suggests that stock-specific accumulation is underway, likely by smart money positioning ahead of potential sector rotation. I shouldn't have included the word smart money because personally I don't believe in this concept, but basically those traders and investors who are well aware of this strategy and who deploy money in a strategic manner. So let us now cover quickly the current market breadth data. Number of stocks above 50 DMA is 80. This tells you that 80% stocks are above 50 DMA. This suggests medium-term improvement in the trend, basically sustainability of medium-term trend. The 200 DMA stands at 53, and number of stocks in higher high, higher low structure on a daily time frame chart stands at 50-51%. Again, you need more improvement here, and more improvement will come if something like metals, something like realty, something like IT, they start to do very well. And of course, it would be really positive for the market if the SMID space, which is the small mid micro cap space, majority of stocks can start moving up above 200 DMA. That is what is going to give further stability in the market. That is what is going to bring more money in the market, because retail traders and investors as such invest more in the small mid micro cap space. They're not interested that much in the large cap space. Next slide I'll cover is about the geopolitical overhang that is capping risk appetite in the market. And this is a big thing and you have to understand. A potential catalyst that markets seem to be waiting on is the resolution or at least clarity in the ongoing Israel-Iran conflict. The uncertainty in the Middle East continues to hang over global risk assets, especially as it relates to oil prices, inflation expectations, and global trade dynamics. Why this is important? Because unless and until the Federal Reserve has a clarity of inflation expectation and global growth, it is not going to go ahead and cut interest rates. If it does not cut interest rates, the market won't be flooded with liquidity. If the market won't be flooded with liquidity, volatility in the direction of trend will continue. Until there is greater visibility, institutional investors appear reluctant to commit large capital in either direction, preferring instead to accumulate selectively in high conviction names. And now if you go back to the stronger pocket data, this is what is happening. In Indian market, defense, finance, private bank, Bank Nifty, capital markets, CPSE, infra, commodities, these are the stronger pockets. And that is what you're seeing, that the stronger pockets are getting stronger, whereas the weaker pockets are still not getting that kind of money inflow. This is in line with what is happening in terms of geopolitical outlook. And let us not forget, the tariff deadline is also near. So do expect a lot of volatility. It is not going to be so smooth. Volatility will be there at any given point of time. 3-5% kind of pullback correction will be very normal, because the market does not have the kind of certainty that it wants in terms of a smooth trend that can play out in the market. And the Israel-Iran conflict, it appears to be between two countries, but behind the scenes, there are a lot of things that are happening. There is a lot of global political games also that are going on. And it is not that it is happening today. It's happened in the past 10 years. It has happened in the last 20 years, 30 years, 50 years, 70 years. And it is going to happen for the next 70 years also. Let me now explain what you should be doing in the current market. Let's say you miss out on everything that has happened between Jan and June. What do you need to do now? First thing, focus only on the stronger pockets in the market. And second, let me take you through what structures you need to go behind. So if you look at all these charts that I'm going to share, there is something that is common in all these names. And what is common is that you will find a prior trend in play and then sideways consolidation towards rising 50 DMA. And all these charts will have a strong relative strength. So what are you doing here? You are positioning yourself in stocks that have risen. Risen means that have proven their trend, moving sideways. That is, they are waiting for broader market to make a move, and then that is your cue to go long. I haven't shared the stock names and the price scale for obvious reasons, because now it is not allowed, but I hope you get the point here. Such similar structures, a prior trend retracing back to 50 DMA, again moving up. A prior trend retracing back to 50 DMA, overall rising relative strength, pulling back to 50 DMA. Again, pulling back to 50 DMA, this is a beautiful trend in play. Look at the rising relative strength. These are all stocks from stronger pockets in the market. A prior trend in play, a pullback to rising 50 DMA, beautiful relative strength line. Again, a prior trend, beautiful pullback to 50 DMA, nice contraction that is happening on the chart, beautiful relative strength. I haven't included the volume data, but if you pull out the volume data, this pullback is actually on very little volume. Again, a prior trend in play, pullback to rising 50 DMA, beautiful relative strength. So this is what you have to do. You have to go behind only those pockets, those stocks that are proven winners, that have rallied from the lows of March, and that are pulling back to a rising 50-day moving average. Because this is what trend is all about. I'll cover one more example for you. Again, a similar trend in play, a proven stock. Volatility is contracting. Look at the relative strength in play, a rising 50 DMA. Over time, this will head higher. This is a simple pattern that works again and again in the market. Regarding my verdict about the market, it is the same. We are heading higher. In between, we are going to have volatility, a 3-5% pullback. I don't know whether it will happen after the tariff kind of date collapses or something else. Do not forget, we have a lot of geopolitical problems that are currently happening in the world. We have a really volatile president, and a really volatile president will usually lead to really volatile markets. So these things are out of control, out of our control at least. All you have to do is go behind such structures, have a logical stop loss. A logical stop loss is usually a pivot below the 50 DMA. If you want a deeper stop loss, then it is the next major pivot below 50 DMA. And then leave rest in the hands of the market. That is the only thing you can do. You have to understand that ultimately in the game of stock market, riding trend is never easy. It is not easy because market will always climb the wall of worry. And you always have to understand that unless structures change on the chart, you have to be with the trend. Short term news, noise, the videos that you see of the conflict that are going on, the red headlines that you see every day, these are all designed to push you out of your positions. Your job is to ignore everything, stay with price, and stay with charts, because everything else is speculation in the market. What is going to happen tomorrow, nobody knows. Your job is to enter and then manage risk. So last week's comments were all answered. Even the comments that you sent me on Instagram, some private personal queries, those were also answered. Leave your comments below. And follow me on my social handles. I have started updating again on Twitter, that is X, but I don't reply on X, and I hope you know why. But your personal queries, if you have some, I'll definitely answer it on Instagram DM. Rest of the queries you can leave it below. So have a great weekend ahead, guys. Take care and be safe.